So welcome to another video in the series. In this chapter, we'll be looking at aggregate demand. So going right into it, aggregate demand is basically the sum of all planned expenditure in an economy. So there's only four parts you need to really know about it. And that aggregate demand is consumption plus investments plus government spending plus the net of exports minus imports. So in an exam, if you have to give the definition, it's best to just give this part over here and then just explain that it means this thing up here. So let's take a look at what each of those individual parts mean. So consumption is quite easy. It's basically just all the consumer spending. So essentially, it's just the household consumption that you have. So yeah, this is a dash, not a minus sign. So what it really means is it's the consumer spending. And another way to look at it is it's a household consumption. So the next one is investment. And investment is the spending by firms on capital to increase their assets. So when you say, what is an investment, the idea is that a firm will spend more on machinery and stuff like that. And by increasing the assets, they can make more goods later. So by increasing your assets, that's basically investment. Government expenditure is quite self-explanatory. It's just spending by the government, and this includes government consumption and investment. So both what the government consumes and also what they invest into the economy. And then we've got exports and imports. So exports are just the value of goods and services which are produced by a country's firms, which are then sold abroad. And exports are just the opposite of that. So the value of the goods and services which are produced by a country's firms, which are then taken in. So basically, the idea is that the consumers in my country will buy the goods and firms from another country, and that's an import. Whereas if I make stuff and sell it to the other country, that's an export. So in exports, you're kind of selling stuff out of your country, and imports, you're taking stuff in from other countries. Cool. Then we've got something called the interest rate. So the interest rate is basically the cost of borrowing money or the reward for saving money. And that's usually expressed as a percentage of the money which you save or you borrow. So if I'm taking a loan from the bank for £1,000 and they might charge me a 10% interest on it, that's how much money I have to pay for borrowing that £1,000. So at the end of the day, I'll have to pay £1,100 back to the bank. But that was for the privilege of being able to borrow the £1,000 from the bank. And also, we've said it's the reward for saving. If you put your money in a bank account, if you got like 0.5% a year, then for putting in £1,000, you'll get £50 a year just because you put your money in the bank. So that's basically what interest rates are. Then we've got something known as the wealth effect. So the wealth effect is basically just the idea that people tend to spend more as the value of their assets rise. So imagine you had a house, the house price went up. You know that your house price is now worth twice as much as what you bought it for. So you feel richer because you know that if I were to sell my assets, I'd have more money. So the wealth effect is basically as my assets increase in price, I am more likely to spend money in the economy because I know that I have essentially more wealth. Then we've got something called corporation tax, which is just a tax on the profits which are made by companies. So if I was Amazon or Apple, then the profits I make, the corporation tax is basically a tax on those profits I make. Then we've got government bureaucracy, which is the level of paperwork and regulations that is needed to make a decision in the government. So it's kind of like what you might know as red tape in the government, or you might notice this in your school or place that you worked at. Sometimes you want to do something which is really simple, but there is a lot of paperwork and regulation involved around that, which makes it a much more difficult task than it needs to be. So basically, the amount of paperwork and regulation that you have to go through just to make a decision is known as government bureaucracy. And then we've got something called fiscal policy. And fiscal policy is just the idea that these are policies where the government will basically change the levels of taxation and government spending in order to influence AD and levels of economic activity. So if you think of the word fiscal, just think of the word taxation and government spending. That's basically what fiscal policy means. How do we change taxes and government spending in order to influence aggregate demand? So then finally, we've got net exports, which is just the value of exports minus the imports. So that's just the net of that. And then we've got exchange rate. So the exchange rate is the rate at which one currency will trade against another on the foreign exchange market. So it's basically just the price of one currency in terms of another. So, £1 is worth €1 or like 1.2 euros or something like that. Or maybe you say £1 is worth $1.2. That's basically what an exchange rate is. So it's quite a short topic, but just make sure you understand each of the separate words, and that should be good enough for this video. And if it was helpful, please let other people know and share this one around. And as always, you can print this off in the link below and revise it yourself. And I will see you in the next video.